Always takes a few seconds. I don't know why. I never know when it starts recording.
Can probably assume it's recording now.
No.
There we go.
All right, guys, we're live. Well, not really live. I have to stop saying that. Guys, we have the legend, Tavi Costa. I'm super happy to see that he's not a robot, but he's perfectly dressed, so I had to come for the occasion. No more short sleeves. And look, me and Kevin are super honored that you're coming with us. We could talk charts, and I think you're the perfect person to try to bridge those fundamental narratives, because I think you guys do a lot of research, and what we see in the charts and what you see, because your charts, man, they like with that black backdrop, like we're talking, man, they're starting to be a Crescat trademark, right? We know that's a Tavi Costa chart there, or it comes from you guys, right? When we see those black backdrops. So Tavi, if you want to introduce yourself for the folks that like don't know anything about you guys there, this is it.
Well, thanks for having me, guys. It's a pleasure to be here. I've worked with Crescat Capital, portfolio manager and a partner of the firm. We manage 3 hedge funds, and one of them is recently launched in the precious metal space, very focused on gold, silver, and other commodity discoveries as a whole. We've been involved in a lot of investments in exploration of commodities. Done well so far, and I'm mostly focused on the macro side. So I cover most of the sort of the macro narrative that we think should be emphasized in the markets today, and what we think is the most attractive opportunities as macro trades and macro assets that may benefit from this environment that we're living in today. A lot of thoughts to put out there, but I'm very glad to be here, and hopefully we can share some of those thoughts with you guys too.
Well, it's fantastic to have you with us, Tavi, and obviously we've had a very trying time over the last 18 months across the world, really, with everything that's gone on with the global pandemic, and that's clearly had an impact on the markets and caused shockwaves around the world. It's been felt across all the markets, precious metals as well, and commodities seem to be reacting quite strongly as well at the moment. So with gold having moved from its lows and sort of gone up around about 70-80% in value, and silver having a surge as well, a long pullback since around about this time last year. In fact, around about 11 months, it's been consolidating. While some of the commodities, of course, lumber sort of springs to mind as having had a very, very strong surge and strong spike recently, amongst others, and oil as well. Just wondering what your thoughts are on those sort of macro factors and what's driving markets at the moment.
I think you're right. I think since 2018, gold was up about 75% until it reached the level of August or so, and then we saw a consolidation period, and cyclical commodities took off after elections. Well, we should say really after the vaccine news that came out 1 week after elections, and that really changed the game in a lot of ways. But in a way, we've seen, in my opinion, what I call the 3 pillars of inflation. And those drivers are really running at full cylinders today, which I think it's very important to think about the new market regimes and how we may see different assets performing today relative to what we saw in the last 10 years. And so I think there's a big risk that inflation may continue to surprise on the upside relative to most people. I would say that on those 3 pillars of inflation, which is involved to why I think commodities can do so well, have to do with demand pull. Personal savings is still really high relative to other times in history. Even adjusted for inflation, you got this net worth transfer from the public sector to the private sector that we haven't seen in other parts of history. And then we have this bottleneck supply issues, which we can get into. It's a very interesting thesis, but it's what's happening there is kind of like the 1919 Spanish flu and the lack of investments in the commodity space. And on top of this all, you got this labor shortage issue where we've seen a 30-year decline of wages and salaries growth. In my opinion, we're about to see a change on that, and that will mark a structural shift for inflation, in my opinion, as we've seen other times in history when wages and salaries are growing. That creates, that kind of reinforces the inflation in the system as a whole. And the third pillar, which I think is important, is the debasement of currencies and the monetary dilution that is being used to suppress interest rates and also to allow the government to continue to pile on more and more debt at lower and lower cost of capital. At the same time as you have record valuations in equity markets, which basically the Federal Reserve, in my opinion, is trapped. And so 3 pillars, and the fourth one, deglobalization. I think it's a start of a pattern that began with Trump, and now it's been still rolling in different parts of the world. And I think all those factors together is what ties up well with this inflation thesis. And commodities, in my opinion, is one way where, as an investor, when do you buy commodities? Not every time. You buy commodities, in my opinion, when investable assets yield less inflation and real rates turn negative, and that's exactly the case right now. And so, regardless of upwards and downward moves in the short term, I think the macro trend for the next 5 to 10 years is that commodities will outperform equities. And so that's the relevance of portfolio management, in my view, is into that idea.
It's like I've always wondered, like maybe you're going to give us some insight. When people say, "Oh, I see," let's say I see commodities outpacing, let's say, U.S. equities for the 5 to 10 years. Are you using like a ratio chart? Because it's so funny. Because if I do the Dow to silver ratio chart or something, and cycle analysis, like Kevin does a lot, that's pretty much the target also for us. Like a peak maybe in silver 2027, 2028, gold maybe a little later, but everything's pointing for like pretty much the range that you told us there. Like it's going to go on full throttle in favor of commodities until later this decade.
Yeah, and I think the importance of that chart, the commodities to equity ratio, is that there's really almost two important stories in that chart. Really, one is the inflationary one, which creates this need for commodities and folks, using capital flowing towards this market. At the same time, you have the other side of it, which is the equity markets being so overvalued, with the risk of even falling apart at some point. Who knows what happens? But in my opinion, the higher the inflationary forces we have, when you're looking at positioning your portfolio, the higher inflationary forces rise, the more should benefit commodities. But at the same time, even though it's counterintuitive, the higher the deflationary risk. And that's because as inflation rises, it's becoming more and more difficult for you to justify the valuations we have currently. And so by deflation, I just mean the risk of equity markets having issues and the risk of the market starting to pricing. Can the Fed continue to do what they have been doing at the same level that they have been doing? And I'm not talking about reversing those policies. I'm just discussing removing some of that liquidity. And I'm not sure the market is at a place where it could take higher inflation than what it is right now, on top of a little bit less liquidity from the central bank side. And so that is how I see risk. I see continuation of commodities doing very well. I don't know if it's the cycle of commodities to equity ratio usually takes about 5 to 10 years, but you may see commodities doing well for 5 years and then equities not doing so well for some years. And so if I guess I'm really focused on both sides of that trend and not so much one side. And there's ways I think you could do in order to hedge that risk. And right now I think inflation is the economy is running really hot. There's some signs of deceleration of the economy right now, starting to show some signs of deceleration. But the inflation in the system is much stickier. So there's a risk of stagflation kind of entering right now. And the more we see inflation actually, gaining momentum here, again, I think investors should be looking back and saying, well, it's not the time for you to continue to leverage on your commodities trade, but perhaps looking at the other side of it and saying, well, what's the risk of a deflationary bust, which would be short-lived in my opinion, but it's a type of a setup that I think it's important from a risk management perspective.
So, Tavi, I sometimes look at the charts and look back at the late 1960s and the 1970s and look at what was going on then with inflationary forces and interest rates and commodities and all that kind of stuff. And there's a lot of similarities, but my sort of difficulties in trying to sort of figure out what's going to happen next sort of revolve around how things were controlled in the 1970s and how the Fed and Paul Volcker were able to come along and put interest rates up to 10, 15, 20% to control inflation. And just looking at the sort of the pure mathematics of it at the moment, with the quantity of debt the United States has built up, and the 30 trillion plus, and that's not taking into account unfunded liabilities, of course, and the fact that we've added something like 7 trillion in the last 12 to 18 months, and it had taken about 7 years to add 7 trillion prior to that. So it seems to be a sort of an exponential rise. So with this heavily increasing debt burden, it seems to me that the room that the Fed has to actually raise interest rates in a meaningful way to try and control inflation, and I'm no expert on the dynamics that are involved here, but just looking at the pure, very simplistic mathematics of it, it sort of feels to me as though pushing towards 2.5% or 3% interest rates to try and cool down inflation would probably have a bit of a disastrous effect, and let alone trying to push interest rates up to 4 or 5%. So I suppose my question that I keep asking guests is, how do we get out of this? Is there a way out without something really bad happening?
But just going to share my screen because I think that's a chart that kind of explains some of the things that you were talking about. Look, I think it's a very tough scenario where we are in terms of the Federal Reserve. It is trapped. I mean, a mandate of stability of inflation and maximum employment has nothing to do with what they're doing. If you look at any macro data, clearly we are the strongest growth we've seen, tied up with a lot of inflation. And if anything, they should be doing the opposite of what they're doing right now in a huge way. But obviously, we all know that the level of debt and the valuations of risky assets doesn't allow them to do so. And the similarities with other times in history is important. One of them that a lot of people talk about is the 70s. In the 70s has some similarities, especially with the fact that we saw this break of the gold standard, which is just as impactful as the kind of QE, unlimited QE situation we have today. And in fact, the unlimited QE is sort of a progress, not a progress, but it's an evolution of that disorder that we saw back in the 70s, and in the lack of discipline from the fiscal and monetary side. Now, the issues with the 70s is that, sure, we didn't see inflation at the same time. Interest rates were able to rise because of the debt amount was not as severe as we have today. In this chart, we show that U.S. government debt is 128% today. Back in those days, we're at 32, 31%. So the difference is staggering, but and allowed the Federal Reserve to have an interest rate policy that was a lot more negative on the real terms when you subtract consumer price index, which is extremely understated of what the real inflation is in the system. So how do you go from here? Then you start looking at other times in period. Well, let's call it the 40s. The 40s has a lot of similar things. The debt amount was definitely there. Not overall, but the government debt was about the same where it is today. Interest rates were suppressed. The Fed did not raise rates as they did in the 70s. Inflation was more sporadic, but it did last longer than a lot of people think. In fact, it stayed above 5%. Today we're at 5.4 in CPI. Well, inflation back then it stayed above 5% for 2 years during those two spikes that we saw in the 40s. Regardless, commodities did very well during those periods, especially in the 40s. And so what are the differences with the 40s is that we didn't have the same valuation of equity markets, and the suppression of interest rates was, yes, somewhat caused by the Federal Reserve and U.S. banks, but there was another thing happening at the time. There was a World War II that made a lot of investors buy war bonds and fund a lot of the war. Let's go back to kind of put into perspective. The World War II costed about $300 billion, which is about $4 trillion in today's dollars. The Americans bought about $185 billion worth of those bonds. And so it's quite interesting to me how much they actually funded. And today, who is buying all the treasuries, the tsunami of treasuries that we're seeing of being issued in the markets today? It's not Americans. It really is the Federal Reserve and U.S. banks. That's about it. The rest of it, we're seeing a declining trend of especially foreign investors. They used to participate in this market a lot more back in the days, and we're seeing a declining trend of that. So the Fed is being put into a position of debt monetization, of buying those treasuries to fund fiscal stimulus and have large deficits at the same time to suppress interest rates. It's one of the most peculiar thoughts and ideas that we've seen in a long, long time. But making it a scenario like the 40s or the 70s has nothing to do with that. I mean, it's a lot more extreme than that. We didn't see the valuations we have today. In fact, if you look at overall debt, including private sector debt, it doesn't get anywhere close to what we saw back in the 40s. So you kind of get a little bit of the worst parts of each of those two scenarios. Let's look at another difference between the 40s. The tax rate policy was completely different. I mean, back in the days, just for you to have an idea, it was the highest tax bracket was about twice or three times about what it is today. So we're about, let's say, 37%. Back in those days, we were somewhere close to 80 to 90% at some point.
What?
Yes. The bottom 50% on the other hand, which say, the lowest tax bracket, was also twice the size of what it is today. So there was a lot of policies in place that, in a way, it would pull down inflation. I'm not saying those are the main policies. People tend to look at one factor and say, well, that's the factor that's going to play out today. No, it's a lot of factors. That's one factor that is disinflationary that happened in the 40s was the level of the tax policy and how that was playing out. Another thing was going on, which happened in the 40s and the 70s, and it's not happening today, was the government acknowledging that inflation was a problem. Sure, they called it transitory here and there, temporary issues, but one thing they've done is that they had a lot of issues with not allowing prices and wages to rise significantly. So there's a lot of policies in place to not allow that to occur. Today, we're talking about adding another infrastructure development on top of what we have and calling the root cause of inflation being that we don't have infrastructure developments. Sure, we need some infrastructure development, but the root cause of inflation has nothing to do with that. It has to do with the three pillars of inflation, savings rate being so high relative to history. It has to be the net worth of individuals increasing over time because of the transfer of wealth from the government to the people. It has to do with the labor shortage. It has to do with the lack of investments in commodities, the monetary dilution to suppress interest rates. How about all that? Why don't we change that part first before we fight inflation? Well, parts of that we can't even change. Now, as far as monetary stance, you can't even do anything about that. So now going back to your question, where do we go from here? I think that if we go back to the chart of the 70s, which is in right here, you can see the inflation kind of build on itself. It had waves on it. And I think we're going to see those waves this time around. I think we're going to see a wave that is going to actually bother the equity market, and we're going to see a retrace and then a retracement of that trend. And then we're going to see another upsurge in inflation, because when inflation comes out and becomes prevalent as a narrative among people, that builds on itself. And it's going to look like a lot of the 70s, in my opinion. Again, note the cyclicality of inflation. It's not going to be a straight line, in my opinion. It will have cyclical moves up and down, but the gradual increase over time with this. And the most important chart when you look at commodities to equity ratio is how that tracks inflation over time as well. And so it makes you believe that if you're going to have an inflationary problem more persistent running in the system, then you want to be holding those assets. And so that's the way I see it. I don't think it's hyperinflation, but that's the way I view this.
Hold on, Tavi. I just put an order. I just doubled all my positions in commodities after seeing this chart. I just doubled everything. Well, yeah, that Fed fund rates to inflation. Can I share my screen 2 seconds, guys?
You go for it.
Because that one's mine. That everything's related. Like Tavi, like I've noticed the inflation rate, the Fed fund rates. All this stuff, it's you look at the charts and their velocity, it kind of overlaps. Here I try to reproduce rapidly the Fed fund rate minus the inflation rate. So it kind of looks like I think your chart that you had. And the only thing I notice here, and Kevin's probably going to tell me. So here we have this is the weekly chart, 1, 2, 3, 4. It looks like a breakdown. But actually, Kevin will tell us that this is probably a false breakdown, and we're looking at actually is through the apex reverse symmetry move like that. But
from a technical charting point of view, that's what that chart is kind of screaming out, because it's not a sustainable breakdown. I mean, you can't just have that plunging down to -20, -30 or something ridiculous like that. And the fact that it's broken down from a long established chart pattern,
Wow.
it tends to suggest that the breakdown is violent and the move upwards is going to be just as violent as it was with the I think it was the 10-year. I'd have to go back in the one or two of the charts, but I think it was the 10-year rates was doing the same sort of thing, real rates as well. So a lot of the charts are sort of displaying these false breakdowns and rapid reversals. In fact, we saw it in some of the commodity indices as well in the last sort of 24 months, where they had false breakdowns and then reversed rapidly. So yeah, that's how it looks from a technical charting point of view. Patrick's
how for you guys in terms of your framework on working and on looking at things, how do technical analysis and macro indicators work for you guys?
Well, could since I'm like a neophyte in macros and understanding the tidal waves, if I can chart it, Tavi, I could start looking at the chart itself, if there's repeatable fractals or patterns or classical TA. So the chart in itself, I could try to analyze it, see this is descending channel. So we might actually so these are the real Fed fund rates, right? The inflation adjusted. We might even have a spike down through this horizontal trend line, and here this bearish channel, we're going to probably go touch it. And if we do, then once you touch a channel, then the next target is that to go test that upper channel. But after that, as soon as I go in a rabbit hole, well, of course, like I'm checking out silver. So how the hell does this how does this react to silver? Then I'll overlay the price of silver. And then that's why and then after that, I'll try to see correlations, how that fits. And it's all about that evidence to see if that chart is pointing to that direction, and that the other chart's also breaking out on its own merit. And then you've seen in the past that when they both move together, you've had strong moves. So you see here, in the 80s and 70s, silver actually bottomed when those real rates bottomed, but it went up as the real rates were going up. It actually went up, and then when it had that parabolic melt up in the 80s, that's when actually we hit rock bottom in the real rates. And if it just, the charts, that kind of help you remove the narratives of today, everybody, they have to track real rates. Well, do they really? Because if you look far back enough, you'll see situations in history, like you said, the 40s was slightly different. And even here in the 2000s, there were periods where, look, we tracked the real rates perfectly. And then there was periods where something else was driving silver. Maybe it was discounting something else. There's a lot of drivers going in. So we start building it like that, comparing it to one with one, see how the chart pattern resolves, and then you could cycle through all the other potentially related. Here's my precious metals checklist. And Kevin, I just noticed this today. Look at sugar. Look at sugar, man. It's insane. Hollow candles. I'll remove and silver and sugar. Look how silver and sugar, they react perfectly. And if I zoom in on sugar, I'll put my Stan Weinstein setup. Check it out, Kev. Sugar, after doing a perfect backtest on the 30-week moving average, is breaking out, man. So if that's not inflation continuing, I don't know what is.
I'll answer your question, Tavi, when you're sort of talking about fundamentals and macro, and this is the way that I see it. And like Patrick, my specialism is in technical chart analysis, and the chart will be suggesting something, whatever it's suggesting to me. Technically, the chart will be suggesting that there's a support line there and that the price is going to turn around and something's going to happen. And that was the case with, I'll just give you a completely random example, Bitcoin. And Bitcoin, there's been a big debate about which way that's going. And the chart that I've been following, the chart that I've been drawing, that all my followers will know I've been drawing, is based very strongly on a cyclical arc formation. Now, we had an inverted arc that was forming before the news came out about China and before Elon Musk sent out his tweet that allegedly sent Bitcoin down by 50%. But the chart pattern was already indicating that there was a bearish pattern forming. Call it a Wyckoff distribution pattern, call it an inverted arc in my terminology. And then the same thing's just happened. We've got a large arc that indicated that Bitcoin was either going to turn up strongly and the bull market was going to resume, or it was going to break through that line in the sand, and we were going to be entering a sort of crypto winter kind of thing. Now, it just amazes me that as the price touched that line, just as it came down to touch that line, all this news comes out, all this positive news that's flooding the news channels, and Amazon are saying this and so saying that, and this narrative develops that kind of suggests that, oh, that's why the price of Bitcoin is turning up. But you go back to the chart that I've been sort of showing for weeks and weeks now, and this particular point in time and price was already, it's almost like it's predestined and predetermined. So which comes first? Is it a technical analysis in the chart that supports the price, or is it just total coincidence that this news comes out and price bounces off the support line? I sit there sometimes and just my mind is blown. I have absolutely no idea what's controlling all of this, except that I know mathematics and kind of Fibonacci and all these chart patterns, whatever people might say, and they might say it's all a load of hocus pocus. It kind of, I don't know. It sends shivers down my spine. I know Patrick's the same sometimes. You get these reactions of price, and whether it's because trading is largely automated, and a lot of the algorithms that are predetermined and preset know in advance where these points are, and that starts the price moving in the opposite direction. Could have something to do with that. It could be a fairly simple and straightforward explanation. I don't know, but it just amazes me sometimes how these news items just suddenly appear just at the crucial moment. I know Patrick's wanting to say something there.
No, well, yeah, well, I think you have to zoom out. So that's why, Tavi, the macros. So if you say macros is long term, right? I don't think can a macro be based on weekly stuff? Like, no, like the macros is like you showed us, it's like inflation rate from like long-term cycles, long-term gold to silver ratios. So those macros are critical for the cycle, for the timing. Like there's one, every time I see the price pullback that's in commodities, I take a step back. I look at the Dow to silver ratio and I sleep well at night, because even if the US equities do blow up, they're pretty much at the rail at the bottom. So my risk to reward, the only thing I'm losing is time, right? Of course, but I'm not buying like deep in a cycle where the commodities have been outperforming. We're not deep in a cycle where inflation rate is at 10-15% for years. It's the first year, right? We're turning positive, because last year we were negative, right? So we're at the bottom of this inflation rate cycle.
So I think what another way of looking at it is that the macros are sort of an upward pulling factor on commodities and precious metals and all that kind of stuff going forward. So you have this kind of upward drag that is more likely, so that when stuff happens, it's more likely to resolve in an upwards direction. So suddenly your risk to reward, your risk to the downside is starting to decrease, and your reward to the upside is starting to increase in terms of probability. I'm a mathematician, so I look at everything in terms of what's the most likely outcome. Nothing about the future is 100% determined. Nothing's fixed. But what you can do is you can weigh up the macro and weigh up the technical chart analysis that goes back 20, 30, 40, 50 years, put the two together, and it kind of brings you to a conclusion that the odds are stacked in this direction or the odds are stacked in that direction. It's a little bit like assessing, which is the most likely horse to win a horse race. You kind of want to know at the start if one of them's got a heart condition or arthritis or something. You're stacking the odds in your favor, aren't you? And that's kind of how I see it.
Yeah, I tend to think it's the more information you have, the better. However, it is incredible how when you get those moves where the macro, the fundamental, and the technicals align, is really where you get those explosive moves to the upside. And so perhaps that has to do with what's happening with Bitcoin. I think that silver has that potential to be that type of asset, and I think there's a lot of precious metals companies that are in the same position, given that fact. However, it's for me, there's also a lot of macro guys that don't like to look at the value stuff, and I think value it tells you a lot about what's happening in regards to the macro scenario, and especially where you are in terms of the cycle. The business cycle as a whole is very well priced into valuations. And the technical side is just a beautiful way of looking at investment or investors' behavior when it comes to the way that they look at or react towards news and so forth. And I think that's the finding momentum trades or big reversals and or large long-term trends I think that's where the technicals really help you to kind of be grounded into, it's tough. It's tough to come up with a macro and value idea that is not proven on the technical side.
Yeah.
And so it's the behavior is very, very important.
Look, I'll tell a small story, but then it's also a question for Tavi. Look, so let's say in 2010, I was convinced that gold was going up because of this. And that was my narrative. That was the macro. I had a chart. But then years later, I realized, oh man, Patrick, that was not what was happening at all. Like it was something else. And knowing that I could be totally wrong on the narrative, and because the price action often goes in line with your narrative, not because the price goes with it, that your narrative was correct, right? It could be something else. So that's why I stray away. I love like the weight of evidence, the macro, but like you said, it's hard, right? Because you have a macro thesis. That other guy who has billions of dollars, he has another macro thesis. And that other guy, and all that put together, at the end of the day, all these macro theses that fight one another, we'll see in the chart, right? But I don't know. Like if I see the price goes down, I love attaching it to a news, but at the end of the day, I know that's not what's moving it. There's something way more powerful than CNBC saying Bitcoin's crap, or somebody saying what CNBC would never say that. But it's what I mean. It's tough to be in the macro, and like what you're trying to do, to have you much respect, as it's tough to do it properly, and to like go do that research from the 1940s, and not because also people don't have the data feeds from the 40s, and then they assume nothing happened before 1970. So if it has to be like 1970 today. It could be a mix of 1970s, 1940s, something new, right?
That's more where I am in terms of my view, definitely in that. And it's unfortunately a combination of the two worst parts of the macro factors that happened during those two periods. And it's not doom and gloom. I mean, there's a lot of good things that will come out of this in terms of opportunities in the markets. But indeed, we're in a situation where there's a lot of issues. There's a lot of issues in regards to valuation of assets, with how policymakers are not paying attention to inflation the way I was referring to the other day, about especially back when we were seeing the pandemic issues, and we're all concerned about remember, we have clients in China, we have investments in China as well, and we're very concerned about what we're hearing about the pandemic and how their economy was closing down significantly. And that kind of gave me a level of conviction to what was occurring at that, which I can't really match with any other time in my career. But today I can actually match with that. I mean, I've never seen politicians not completely ignore the inflation thesis the way they're doing compared to other times in history when we saw inflation reaching 5% on the government understated data. Yeah. And so I'm a little scared, or I should say I'm very scared, because I think things are going to get a little bit out of control in regards to that. And from a macro side, I think there's a lot of signs of that already happening, especially from what I believe it's likely to happen in regards to wages and salaries, that will become a structural shift into this inflation story. And so that's one of my big calls. I really think wages and salaries will increase, and there's going to be a lot of changes. Margins will be squeezed. Companies will have to deal with higher labor costs, and companies that don't have pricing power will have issues, and profitability will come back. We'll see leadership changing in the markets, where it's kind of like where we're seeing energy companies leading the market this year. What was the last time we saw that? So it's been always technology and consumer discretionary. That's been the story of my life for the last 10 years, right? Now that's changing, and a lot of people are not seeing that change, especially politicians. And so I'm a little concerned about that. I'm a little concerned about the way we're leading the pack here. It seems like there's a lot of policy errors, and I think we're going to see the damage in the next months.
Well, it's worrying when you get to the stage where the sort of the rate at which the debt is accumulating and increasing means that you can't even sort of go sideways with an interest rate of 2.5%. It has to be on a constant downward trend, with interest rates, sort of zero bound and real rates negative, and this whole sort of era of ever decreasing interest rates. That's clearly been in place to sustain and allow the management of the debt and being able to meet debt payment obligations. How those debt payment obligations will be met. I mean, here in the UK, our debt is soaring. It's making news headlines on the BBC News, which is quite unusual, with policymakers and opposition politicians clearly starting to realise that the repayment capability of the United Kingdom with its national debt is starting to become questionable, particularly if interest rates rise. Now, times that by 100 for the United States, and with global reserve currency status, if a country like the United States starts to have any kind of question mark over its mathematical capability to repay its debts, becomes a little bit of an issue, to say the least. Which is, it's a circle that I find hard to, imagine how you square that circle and resolve the issue. Maybe very high inflation can make the debt mountain shrink in a comparative sense, but very high inflation makes debt repayment surely out of reach. I just don't see how you get to that point where you can sort of sustainably sort of print your way out of this problem.
Well, and the thing is a lot of people are seeing that situation as the deflationary setup, and I respect a lot of deflationary parts of the argument, because I think it's mostly on the risky assets, valuations, where I think the reckoning of that would be largely deflationary, not inflationary. But at the same time, looking at the levels of debt that we have in the system today, the difference is that when you have a lot of private sector debt leading the way, it is kind of the case, but not in a major way. In other words, households, we only transferred the imbalances that we had in the past from the private sector to the government sector. That's really what's happening, where we allowed companies sometimes to get better terms for debt. We allow households to get money and perhaps pay down their debt, which is what we've seen so far since the pandemic. Some folks are saving money, so the saving rates are at outrageous levels. But the thing is, when you get the level towards the government side, there is no issue with the deflationary spiral of consumers not spending money because they're too indebted, because the debt is on the government side in the first place. And in a way, you could potentially monetize the debt. I mean, it is a possibility. We've seen this throughout history. Why not? Now, is it technically doing that right now? Technically not, but it basically is. I mean, it's purchasing all the treasuries that are being issued at a pace that we've never seen before. Just in the last 2 months, we saw $1 trillion worth of issuances of bonds and notes. That's longer duration bond. I mean, that scares me. I mean, that's the Fed is buying a large percentage of that, perhaps 40% or so. U.S. banks buying another 20%. So you get another 40% that Americans and other investors in other places have to fill it up. Otherwise, the Fed has to step in and buy it. So how in the world can we even talk about tapering in a scenario like this? And so that is what concerns me the most, is the fact that, it is really trapped. It cannot do that. And I joke around, but it's true. What are they going to do if inflation, let's just say we are in the 40s. Everyone likes to use the 40s as a transitory example, because the 40s, we saw this spike and then a decline again. It actually went to negative. In fact, we got deflation in the middle of the 40s. It's kind of weird, but even in that setup, I mean, how in the world would we even, be in terms of the cost of capital today and valuations of companies? What would the Fed do? Shock the world and raise rates by 2%? It wouldn't do anything. It wouldn't clean up the problem. I mean, interest rates up 2%. Look at the 70s. You had to raise interest rates a lot higher than that. So I'm a little worried that the limits when it comes to what they can do, can recreate or reinforce issues that we haven't seen before. And the past, in the history perhaps, and the periods that we saw in other times here may not play as a guide here for us. And I think that it's you kind of have a mosaic of trying to combine those two periods and three periods, because 1910s was a very inflationary period, and see how assets perform during those times, what are the issues that we're seeing today, and how they may shape and form in the following years, wages and salaries growth, deglobalization. I mean, the list goes on, and really is, I'm a little bit concerned about what's going to happen in regards to inflation.
It kind of feels like the culmination of everything that's happened from the 1940s and the 1970s in the modern monetary system, and it's starting to feel as though it's sort of reaching a point where something's going to sort of break in the system somewhere. It feels like the whole thing's starting to shake itself apart a little bit, and it's going to be a real challenge to stop this sort of modern monetary system of ours from completely falling apart. I mean, there may be a planned resolution or a planned sort of way of saving this situation from complete disaster that we're all completely unaware of. Of course, it may involve digital currencies or something. I have no idea, but it does start to feel, looking at a lot of the technical charts to me and a lot of the macro and what you're talking about there, as though it's kind of reaching a point in the next maybe 10 years or so. And it's amazing, these things do have a way of stretching out longer than many people think. I remember 10 years ago, 2008, more than 10 years ago, people were convinced that it was the end of the financial system as we know it. And of course, it wasn't. The can was kicked, as they say, and here we are sort of 13 years later. So it is amazing how long this game can carry on, and how long you can rearrange the chairs on a sinking ship, as they say. So yeah, I mean, but having said all of that, it does kind of feel as though we're getting to a resolution point, certainly.
But the threat of central banks, I mean, central banks can do whatever they want to do for until there's inflation, and when inflation really starts to become a problem, it really changes the picture. We didn't see that in 2009, and I think the biggest reason why is because three pillars of inflation weren't necessarily working all together, right? I mean, we saw the monetary debasement, meaning we saw the monetary dilution from the Federal Reserve buying treasuries as well. We saw somewhat of a suppression of interest rates too. We didn't see the on the cost push, there was nothing like that, right? But there was no issues of labor shortage. In fact, it was quite the opposite. Or think about the savings rate, or the transfer of wealth. We didn't see transfer of wealth back then. In fact, the bottom 50% lost 84% of their net worth. This time around, they gained the largest amount in history. So the difference is just completely different here in terms of the post-global financial crisis, in my opinion. And so for investors, we keep thinking, I mean, you break down the sectors, of the S&P and look at the free cash flow yield of those sectors in real terms, all of them are yielding less than inflation. And so besides some commodities related businesses such as gold and silver, which is still above, they're probably producing somewhere close to 6% or so on the Philadelphia Exchange, gold and silver, about 6% free cash flow yield, nominal terms. You subtract inflation, barely. I mean, the real measurement of inflation, that's probably double digits here, not single digits. Even they are not producing enough free cash flow. So it's a little scary what's going on. And it's, in my view, it reflects all those policies that we've seen. And a lot of people thinking that's not going to have any consequences, because it didn't have a lot of consequences in the past, aside from inflating asset bubbles. But now with inflation in the consumer prices and perhaps wages, how does the Fed, even is capable of continuing those policies moving forward? At the same time, with the levels of debt, they can't do it. So that trap scenario is going to get to a level where inflation is going to be priced in a way where you can't justify companies that have been growing in a disinflationary or positive deflationary environment that benefited a lot of the tech companies. And look at the size of the tech sector today relative to the economy. I mean, is that possible that they're going to be doing as well as they've done in the last 10 years? I don't know. I have my doubts.
Yeah, well, it definitely feels the scales are tipped on an extreme on one side, and we're just positioning ourselves, looking at the charts to see if when they start really turning in our favor, that will be early. Like Eric Sprott likes to say, you want to be alone, quiet in the room, and then when everybody wants to go in, then that door's small.
Yeah.
Tavi, look, man, that's sobering thoughts there, your presentation, and it was a super honor there to get that. Man, it's like that fundamental, it's like that huge macro long-term backdrop that we don't hear often. We always hear those daily news, those dare Twitter, people repeating what somebody said on CNBC, and that's the closest I'll get to fundamentals, is relating to somebody like you who's actually looking at the data from 40, 50 years ago, man. And if you don't look at 50 years of data, I don't respect you guys. Look at data. It's not true, but that data's your best friend, I think.
It is. You have to learn from history. You have to take history's lessons, and you have to draw out from that, what you can learn and what you can apply. Of course, the world does change, but a lot of things don't, and a lot of lessons there in the historical evidence, and that's what it is. It's evidence gathering and pulling together the pieces of a very big jigsaw puzzle. And listening to what you said there, Tavi, you really helped us with a lot of that puzzle, and still lots of questions, of course, and I could sit here all day asking you lots more questions, but it'd be amazing to have you back at some point in the future. But it's been, as Patrick said, an absolute honor to have you with us and talking to us. So,
well, guys, thank you very much for having me. It's been a pleasure. I think this conversation was a great conversation. I like to also kind of pick your guys' brain on in regards to the technical side. So that was fun watching you guys look at those charts, and we look at the world in with different lenses, but it's interesting how we get to the same conclusion as far as our views. And so I appreciate a lot of the work you guys put out, and keep it up. And thanks for having me.
Great. Really good to speak to you.
Our pleasure, Tavi. And guys, go follow Tavi on Twitter, guys, right now. All right. Thank you.
Okay, that's it, guys.